Okay, folks, welcome to Swing Trading Today. This is Bob Desmond, and it is July the 15th, month half over. We could start now taking a look at monthly charts to see how we are shaping up to close out the month. We're not ready to do that this morning yet. We'll probably do that tonight on Thursday Night Stock Charts Live here on YouTube, 6 p.m. Eastern Standard Time. Use the link below to get alerted to our show, and you'll get alerted by email 15 minutes to a half hour prior to going live. If you're already on our email list, do not re-enter it again, please. I don't want you to get spammed. This show is going to be brought to you by TrendSpider, Automated Technical Analysis. Please use that 35% discount code below and take advantage of their new mobile app. Let's get to the show, man. So, yesterday, we had, I can't even believe I'm going to say this. We had U.S. producer prices soar at a record pace in June. So you had hot CPI, both on the core and the headline number on Tuesday. That wasn't enough. The PPI comes out yesterday, skyrockets. Here, to appreciate the number, you have to read this. For context, that is the highest print on record only back to 2010. But for context, that is the highest since a CPI print in 1982. For those of you who are not old enough, unfortunately, I am old enough to remember 1982, for the most part, began the beginning of the new bull market and marked the end of a very long inflationary period where Fed Chair Volcker and President Reagan locked arms and decided they were going to kill inflation. That finally ended in 1982, and that the bull market that you find yourselves in equities right now and in bonds began 1982, for context. So inflation is in fuego. And I mentioned to members last night that this is not just an inflationary period. It is a stagflationary period. Good morning, Clark. Hey, Bob. Hawkish commentary from the Bank of England, Michael Saunders, and the Bank of Canada. Also, yeah, I saw they tapered. Also said that they will taper QE. How do you feel about this market? I think that, yeah, I've taken a lot of heat with regards to short positions, and I haven't been an aggressive short, but I'll tell you, it is becoming more and more attractive to time a short trade on this market. In particular, our short trade of the small caps is working because in a stagflationary environment, it is not the sector where you want to be. So I'm very bearish on the small caps. Your utilities may do well. Low volatility, high growth names, large cap names may do okay if they're paying a dividend. But tech, I think that is going to have its day of reckoning fairly soon. I was very surprised to see yields pull back yesterday. I question whether or not that's sustainable. The only way it's sustainable, in my own opinion, is for two reasons. One, the economy is dropping off of a cliff. Two, the Federal Reserve is managing the yield curve. So, and preventing those longer-term bond yields from rising, 10-year, 20-year, 30-year bond prices from rising, and that takes one heck of a lot of capital. So I'm going to be interested to see what the Fed balance sheet looks like when it gets published today for this past week. So we're going to be talking about that tonight. Again, Thursday Night Futures Live, Stock Charts Live, 6 p.m. Eastern Standard Time. And with regard to stagflation, you know, how do we arrive at that opinion that we're entering into a stagflationary environment? Well, all you need to do is take a look at the price action on the transports, take a look at the price action on the utilities, which I have up in front of you. The energy sector, not utilities, first cup of coffee. They were hammered yesterday. Energy was hammered. This was a leading sector. It is now getting hammered. You would think that in an expanding economy, that energy would be doing well, and that oil would be under tremendous demand. Take a look at energy. Broke support, not one support level yesterday, but two. Oil, which trades like 85, 90% correlation with energy, outside reversal bar yesterday. These sectors, or excuse me, energy sector and oil are rolling over. So expect a correction here. Will it be a crash? I'm not convinced of that quite yet, particularly if we're heading into a stagflationary environment with oil, because if the dollar begins to pull back as it did yesterday, here's the dollar. We'll go to the pre-market action in a moment. But here's the dollar yesterday. And after a very bullish event the day before yesterday, we had the CPI data come out. The typical knee-jerk reaction, which I always mock, is that these so-called Harvard Business School traders, what they do is they go in and they buy the dollar. Why you would buy the dollar on hot inflation is beyond me. You know, if you did that 20 years ago, 15 years ago, 30 years ago, I'd be okay. I understand, because the Federal Reserve has to act now. They have to do something. But the Federal Reserve isn't going to do anything. They've been saying that inflation's transitory, setting the stage for we're not doing a god darn thing. So if they're not going to fight inflation, why would you buy a currency that is flawed? Take a look at this. Pretty face, but not a brain in her head. Powell pushes back against tapering in House testimony. So he's in front of the House, and now the Fed has gone woke. And I'm sorry if you folks out there are on the fringe left side of the spectrum. I don't care, because you're spending my money. And the Federal Reserve is gone woke and pushes back against any tapering whatsoever. That's step one on the path to raising rates. We're not even at that stage yet of letting the Fed's balance sheet, which is like a pseudo rate hike. You'll see yields pop up higher when the Fed ends their buying and allows debt to begin rolling off their balance sheet to reduce their size. Here's why. Powell says economic recovery hasn't progressed enough to begin tapering. Fed Chair Powell, hello? Excuse me, can I ask you a question? You've spent roughly $30 trillion. You have magnified your balance sheet since the financial crisis from $800 billion to well over $8 trillion. What is the very definition of insanity? Mr. Fed Chair Powell, are you awake? Hello, sir? The very definition of an insanity is doing the same thing over and over and over again and expecting a different outcome. So apparently the Fed chair is satisfied with the progress that $8 trillion has done for us and will continue the same insane strategy, even though inflation is ripping through the ceiling. And this is a tax, folks. They're attempting. Don't let them pretend that they don't know what they're doing. They do. They want to inflate away the trillions of dollars worth of our debt. They don't want to admit that there's a huge amount of inflation out there, because what do they need to do? They need to provide COLAs, cost of living increases to Social Security recipients. They don't want to do that. God forbid. So they're going to continue down this path and try to inflate away our debt rather than paying it back. And it's not going to be pretty for the people who they say, this broad here, the people they say here, majority, it's going to disproportionately harm working class, majority Hispanic and black communities like our district in Bronx and the Queens. Folks, inflation hits this community harder than any other community. The rich could sock it away. They'll have hedges on. They'll be protected. The middle class, the communities they pretend they want to help, those people take it on the chin at the supermarket, at the fuel station. They're not hedging anything. They're living paycheck to paycheck. socialist chick, no doubt about it. Notice how you haven't heard anything about her since the Cuban issue. The Cubans are finally revolting over there and saying, no mas, this is ridiculous. And God forbid anybody would have come out and support them. And certainly this gem of a human being won't say anything. They've shut her down completely because they're afraid of what statements she'll make. Let's get to the pre-market activity. Okay. We're long of the gold miners, folks. This is NUGT, directly leveraged gold mining ETF. And we are seeing strength in this sector. I would just warn, I have the NUGT, the GDXJ. What I warn about here is that while we've seen a couple of days of pretty strong price action, they're gaining strength on declining yields and declining U.S. dollar. And I don't expect the declining yields to last much longer, unless, of course, the Federal Reserve is out there priming the pump and managing the yield curve. So it's the gold miners are trading in correlation with what they should, or in inverse correlation with what they should. The correlation that you need to watch is this one here, and that is the VIX, which this morning has popped. This is a 5-minute chart. Let's go to a 15-minute chart. Yeah, we've broken out here this morning, and the VIX is shooting up higher. And there is an inverse correlation between the VIX and Nugget. Because why? Or I should say gold stocks, not just Nugget. Why? They're stocks. They're stocks. And you have a retail investor out there that is margined up. They're leveraged up. So when there's forced liquidation, your broker doesn't care if it's a gold stock, livestock. If he could sell it, they're going to sell it. So just beware that while in the short run, we may see rising prices on these gold miners, which is great for me. I'll do great. The problem is that if the volatility index picks up, you may see pressure on these names as well. So be careful. You may get a dramatic sell-off on these names if this market really begins to roll over. So we're going to keep some dry gunpowder on the sidelines here. And if that occurs, we're going to take advantage of that sell-off. So more to come, members, on the gold mining stocks. Also down here, you could see in the center, lower pane, the dollar is rallying this morning off of its lows. We are still in a, let's bring it up on the big chart. Dollar. We are still in a downtrend on not necessarily a 4-hour basis, but on a 15-minute basis. So if they break it out, you may get weakness on the gold stocks as well. But again, we want to keep that dry gunpowder available to us vis-a-vis capital reserves. And if they sell off the gold mining stocks dramatically, then we're going to be looking to buy that dip, because inflation is here, folks. Stagflation is here, and it doesn't mean good things for the U.S. dollar. Now, moving on to gold itself, we were up higher early. Yeah, we did. We sold off here. We were up about $8 the ounce, and now we're up only $2 the ounce. That's because of fear. The traders are fearing that the dollar is going to resume its move higher, and that's entirely possible, at least for the short term. But what we want to do is we want to keep that higher level view of what's happening out there, and that is the macro picture of the U.S. dollar coming under a dramatic amount of pressure because people don't want it anymore. Remember that over 25% of all dollars in existence were printed within the past 18 months. Actually, a shorter duration and more dollars, but I'm being conservative. Let's check out silver. It was up earlier. It remains up, but it's off the highs. So these names are probably going to come under pressure until such time as the dollar rolls over. Let's take a look at equities. Before we go to equities, let's take a look at the 10-year Treasury note. We want to get a feel for yields today. All right, so they continue to prime the pump here. They're pumping up treasuries. When treasuries are moving up higher, yields are moving lower. So I would expect to see a bid under the NASDAQ 100, and there you have it. Up a 0.25 percentage point. And we are looking for an opportunity here to go adding to our short position of the NASDAQ 100. Microsoft in particular, extremely overbought. You may be looking at a daily chart or an intraday chart and saying, what is this guy talking about? Stop looking at those daily charts and intraday charts. Pull back. Start looking at the monthly charts, quarterly charts, yearly charts. Microsoft RSI, well above 90 on at least on a quarterly basis and a yearly basis. So if they have a disappointing quarter, you could bet we're going to be jumping on the short bandwagon with Microsoft. But I don't want to go adding short if I don't have to in advance of tech earnings. The S&P 500 down this morning by just shy of a 0.25 percentage point. Hey, Sam, good morning to you. Congratulations, Sam. Yes, Italy won. Sam's over in Italy. Congratulations. Big Bear, good morning to you. Bob, if the economy starts to falter, do you think they will go into growth stocks and in tech again? It depends upon what they do with interest rates. There's not all that much they could do in terms of rate cuts anymore. The Federal Reserve has really boxed themselves into a corner. As a matter of fact, it's a great point you bring up, because if you go back to the COVID sell-off, that was February through April of 20. The Federal Reserve did rate cuts. They were jawboning the markets. It didn't help. It didn't help whatsoever. You get a spike in the market, and then you get a rollover, and the stock market would just make lower lows. They were ignoring the Federal Reserve because they didn't have much left in their toolbox. So that's when Powell went to Congress and said, listen, you guys need to start spending money. We need fiscal support, not just monetary support. And he didn't have the authority, and that's when, and I tend to disagree. I think this was President Trump's opportunity to deflate this bubble and allow things to go back to normal, because he ran as a candidate that said this is one big fat ugly bubble. I'm not gonna cheerlead anyone. I certainly don't want Potato Biden in office, but I take fault with President Trump as well, in that he knew that this is a bubble. He should have, as Reagan did, took the bull by the horns and deflated this bubble. And that would have taken the checkbook away from the welfare state as well, and he may still be in office right now. That's my own opinion, sticking to it. So to answer your question, Clark, they're going to need to spend a lot of money to keep this economy from going into free fall. I don't think the Federal Reserve has the tools at its disposal anymore. And you can move on to the Russell 2000. Down yet again, over 0.75 percentage point. We're short here. And we have been in this trading range going back to February on this 4-hour chart. And we are nearing the lows of this trading range, this very, very broad trading range. And man, if this breaks, look out below for the small caps. They're going to defend this. They're going to attempt to defend it anyway. But if we break the May lows, look out below. So if you're wondering what segment of the stock market to watch, if you have a stagflationary environment, look no further than the small caps and micro caps. What else do we want to take a look at here? We did the Russell. We did the NASDAQ. Let's take a look at some commodities. Gasoline coming in a bit. Oil prices coming in. Light sweet crude. Really weakening up here. Wow. Light sweet crude down over 1.5% this morning. Take note of the lower high here. And here is your line in the sand. I'm going to create an alert here because it's no big deal. Right now we're in a trading range on oil. But if we begin to break down below and put in new lower highs, then you really want to avoid our alert set. You really want to avoid the energy names. And I have a bunch of members that are in energy. I know one in particular is heavy into Exxon. You want to avoid those names, maybe sell covered calls. I think that oil will bounce back because of inflation. It's an inflation hedge. Right now, demand, there's a lot of action going on over in OPEC. I haven't read up on it. I don't want to talk about it because I'm not educated on it. But that could be influencing the price of oil. But this chart is coming under pressure. We'll call it a trading range for now. If we break below the lows of the 8th of July, then we're in a short-term downtrend. Yeah, GDX in euro terms is up in near session highs. Right. That makes sense in euro terms. What else do we have here? Let's take a look at protein. Okay. Not much to look at the commodity front here. I think the interesting one is oil. Copper setting up very, very nicely here, folks. Let me take a sip of coffee. For those of you wondering why I don't have my photo up right now or my video up, picture on picture, I have bedhead like you wouldn't believe. I don't know if any of you from the 80s that was a black dude had that straight up afro hair. He was a funny guy, but that's what I look like right now. So copper looking very strong. We're up 0.75 percentage point. You know, this is a very strong consolidation, and it looks like we're probably going to break out, resolve itself to the upside. And you really want to pull back to confirm that decision to a weekly chart. You know, take a look at the weekly chart. The trend, the path of least resistance is clearly to the upside. Yeah, we did have a correction. This is probably what we're going to get in oil, but I think that we're going to bounce back, just as we're doing with copper, and we're going to get a breakout. There is rumor that OPEC might boost production. That makes sense. That's why we're seeing the weakness in oil. That makes sense. At least your hair, I have not. At least you have hair I have not in 40 years. That's funny. Okay. So copper looking good. What else do we want to take a peek at here? Natural gas. Natural gas has been strong. I think this is going to get resolved to the upside. We're down currently, but if you take a look, again, at a weekly chart, we are consolidating and resting. It's a pause that refreshes. This gets resolved to the upside. All you need to do is take a look at a monthly chart of natural gas, and it tells a beautiful story about where it's going. All right, let's pull up members chart requests. We'll take a couple of those. And we have PLTR. Let's go to our friends over at TrendSpider. Folks, automated technical analysis. There is a discount code below, 35% off. Take advantage of. If you're not using this, you're missing an hour in your quiver that your neighboring traders are certainly leveraging. Because I talked to these guys, the management, and they are booming. All right, PLTR. Let's go to a monthly chart. Very rough month here. And these are your high beta names. They all peaked out back in January, February timeframe. And they haven't recovered. I mean, your Airbnbs of the world, your Coinbases of the world, they're simply struggling right now. So at current PLTR monthly time frame, this is not an outside reversal bar or a bearish engulfing bar, but it's bearish nonetheless, assuming that we close down below this support level here at around $24 per share. Next price target is at $20.50 per share. Weekly chart, let's see if there's any reason to go buying. All my alerts expired here. Let's get rid of these. I'm going to create an alert here. And we'll entertain a swing trade if we hit the support level, but not before then. We have more room to the downside. And if you take a look at the RSI, I'll go to that in a second. You'll note that we are weak and getting weaker. So it's not as if we have a divergence where we're seeing lower prices and RSI hold support levels. We're not getting that. We're getting a confirmation of this move lower on PLTR, and that is not a good story to tell unless you're short. And I would not short this stock. There's not enough room to the downside to make the risk versus reward worth your while at this point. Yesterday, a big down move, really big down move. What were we down? Over 4% on the day. And we're coming down here, folks. This is where we're coming to. $20.50. Do we hold it? We'll know when we get there. So I would avoid PLTR at current. It becomes interesting if and when our alert fires off. And it could happen as soon as tomorrow. Let's take a look at another chart request by our members, and that is DKNG, DraftKings. I haven't looked at this one in a while, and we'll go to the monthly chart to get freshened up here. And again, folks, it goes back to that New Year time period. In this case, it was March. It was all the Q1 time frame where everything really peaked out. With these big consumer discretionary names like DraftKings, Penn National Gaming, and we have a bearish reversal bar on the month. We have at current broken support. We don't know if we're going to close it. We're halfway through the month. 45.22, if you want to jot that down, is critical support. We closed yesterday at 44.85. Not too far away to bounce back by the end of the month. But at current, it's not looking good. This is not a buy. Here's that same support level on a weekly time frame. Let's get rid of these aged alerts. And we'll be looking for a bounce off of support. I'll give you a number in a moment. Okay. That would be at, let's call it $40.50 per share. Daily chart. Yeah, this is not looking good, man. This is not looking good. You could see that I just put the automated trend lines on. And I have my own manually drawn trend line here. That broke support. The automated trend lines, if you're not good at identifying support and resistance levels, just click a button. You can see that we bounced off of support in blue, failed to hold it on the 13th. The rest is history. Sellers moved in, program selling, and it looks as though we're going lower. So beware here, folks. DraftKings not looking good. The last chart we have to go over is NEO. Everybody's still looking at these high beta stocks. I'm surprised. I've been warning about these Chinese stocks literally for years now. I really ramped up the rhetoric about the supply chain shock that would occur when COVID hit. And with this DD event that took place over in China, Chinese stocks are uninvestable to me. They have been forever. But even Kathy Wood now, there's an article on Zero Hedge. It's worthy of pulling it up because she finally got the message. Where is it? I want to share this with you because if there's one big, in my own personal opinion, one big grift that's going on out there in the stock market, it's these Chinese companies that are being traded in the United States, yet they're not subject to the same auditing guidelines as U.S. companies. Here's that link. I just dropped the link in the box if you want to take a look at that. ARK funds are offloading their exposure to China-based equities. Took you long enough. I don't know. Why do you think you're going to get your money out of these things? Crazy. You had the CCP go in and they basically told the company, you're not going to grow anymore. You're done. All right, back to NEO. Again, I would not trade these stocks. So a word of warning. For the month, NEO, a bearish reversal bar. They did take it higher, new monthly high, but we reversed. There were sellers above. You have a potential for a double top. Now, if we break support here, we'll move this down at 31 bucks a share. You're probably going to see NEO move down into the low 20s, if not the teens, in a heartbeat. Weekly chart. We've broken 2 support levels on the week. We're bouncing off of some moving averages. Let's get rid of these. These are expired. Watch for a bounce at $40.50 per share. Daily chart. Daily chart. They attempted to form a W formation, and they may still do it. I'm not going to rule it out yet. Here. At $42.68 per share. Now, I wouldn't be a buyer here personally because I wouldn't buy it. Let's pretend this is not a China-based stock. Let's pretend that it's United States company. I still wouldn't buy it at the support level because I like another support level down below better. I don't like the monthly chart. I don't like the weekly charts. And therefore, I'm skeptical of daily support levels holding where we're nowhere near weekly and monthly support. So I don't think this is going to hold. Maybe it does, but I'm not going to invest my hard-earned money in it, even if it were U.S.-based. Now, what I want to see here is this downtrend in RSI come to an end, and I want to see a hockey stick move up higher and a breakout on RSI. That doesn't necessarily mean this becomes an investment, but it becomes far more interesting as a trade because you'll have an indicator potentially, in air quotes, potentially leading price performance. It doesn't always happen, but it certainly is a very good clue if you're a Sherlock Holmes trader like I am. So that's NEO. Be very, very careful here. These high beta names are out of favor at current, folks. Be very careful. Watch for support levels on a weekly, monthly time frame to get hit, because your probabilities of profit are far greater if you decide to enter a long trade at those levels than what are at newly found daily support levels. So with that, everybody have a profitable trading day, and I'll talk to you soon. Be well.